Welcome to this video. So we will be discussing what bad debts are and how do we record bad debts, but that will be for another video. So let's get started off. So you will have a creditor who, for example, loaned a car to the debtor. Okay, so for example, this is a car that the debtor bought on credit. Let's say it's a Mercedes Benz. Okay, doesn't look that good, but let's say for example you bought a Mercedes on credit. Okay, now you need to pay back the money that you bought on credit back to the creditor. Okay, so a bad debt essentially is a person who does not have, there are no sufficient funds in order to settle the debt. Okay, that is what a bad debt is. So this is the definition. Is you have no sufficient funds to settle the debt and you are going to be written off. So the company has no guarantee to receive the funds. You went to the court and they said that you are broke and they wrote you off, and they send that to the company and then they will write you off as a bad debt. So there is a certain procedure, but essentially it means you have no sufficient funds to settle the debt and you will be written off in the books of the company. Okay, so the creditor allowed the debtor to buy this vehicle, the Mercedes Benz, on credit. Okay, so now for example, let's say this Mercedes is worth, just for argument's sake, okay, for argument's sake, let's say this was worth 150,000 rand. Okay, 150,000 rand. Okay, so now the debtor here does not have the 150,000 rand and they went broke, so they couldn't pay off that 150,000 rand. So what's going to happen is that the Mercedes-Benz company is going to write it off as a bad debt in the books. So this will be in the income statement and the balance sheet. You will see that the trade receivables is going to decrease with the amount of $150,000 is going to decrease. Okay, so basically you're writing off and you're taking it out like, okay, they do not owe us anymore because they do not pay, they will not be able to pay us, and you will never see the money again. They do not have the sufficient funds to settle the debt and you are writing it off. You're canceling that debt, that they do not owe you this debt anymore, and it's going to be as if it never ever happened. So that is what a bad debt is, and this is how it's going to affect the income statements, the balance sheets, and all the other statements relating to the company. Okay, so I hope this is clear, and we will do another video on how to actually record bad debts and how to adjust the financial statements when it comes to bad debts. Thank you for watching. Do not forget to subscribe and keep a watch out on the other videos. I'll be more consistent with posting. Bye.